As of 10:11 a.m. Eastern Time, Supermicro ticker SMCI, is trading at $36.44 per share. That is a sharp drop of $1.47 or 3.88% on the day. And let's be blunt, this isn't a buy-the-dip moment. This is a painful, grinding continuation of a multi-month collapse for a stock that was, just a year ago, the darling of the AI hardware space. This 3.88% drop is just salt in the wound. The immediate, surface-level expectation for SMCI has always been straightforward. They are the other AI play. While everyone was piling into Nvidia stock, the smart money, or so the story went, was also buying Supermicro. The belief was that SMCI, with its building block server solutions, was the essential partner for building the infrastructure needed to run all those Nvidia H100s and A100s. They were seen as the fast, flexible, custom solution provider that the hyperscalers and enterprise clients needed. A purer hardware play than, say, Dell or HP. This was the narrative that sent the stock on a parabolic run, a story that many investors using online investing platforms like SoFi or Robinhood bought into, watching their Robinhood investments soar. But that is the narrative. The reality, as this $36.44 price tag clearly shows, is that Wall Street has completely lost faith in that story. The 52-week high for this stock is $66.44. The stock is down over 45% from that peak. And as the historical chart shows, it has been in a near vertical collapse since early October, when it was trading in the high $50. Today's drop isn't an anomaly, it's the market confirming its new thesis. Supermicro isn't the nimble partner to Nvidia. It is the first major casualty of a brutal hardware commodity war. The company is stuck in a vice grip of slowing AI demand on one side and fierce, margin-crushing competition on the other. What we're seeing today is a direct reaction to the company's disastrous fiscal first quarter 2026 earnings report, which came out on November 4th. The headlines were horrific. The company reported earnings per share of just 35 cents, which was a staggering miss from the consensus estimate of 46 cents. Revenue was just $5.02 billion, which not only missed analyst estimates of $6.48 billion by a wide margin, but represented a 15.5% decline year over year. In the middle of the biggest technological build-out in a generation, Supermicro's revenue is shrinking. That is the reality that has shattered the expectation. But the real killer, the detail that is causing Fidelity mutual funds and other large institutional holders to dump the stock, is the gross margin. The company's gross margin fell to just 9.3%. That's its lowest ever gross margin, down from 13.1% in the same quarter last year. This is the entire story. It tells you that their special sauce, their custom, fast-to-market solutions, is not a durable competitive advantage. It was a temporary advantage during a supply chain constrained boom. Now that the boom is normalizing and supply chains are clear, their customers, the large cloud providers, are squeezing them. They are saying, "We'll just go to Dell," or "We'll design it ourselves if you don't cut your price." And SMCI is being forced to comply, destroying their profitability. They are a systems integrator. They buy components, CPUs from Intel or AMD, GPUs from Nvidia stock, and put them in a box. When demand is white-hot, they can charge a premium. When it's not, they are a low-margin commodity box builder, no different than their competitors. This margin compression is the entire story. They aren't a high-margin software company. They aren't Apple stock with a protected ecosystem. The stock is now trading below its 200-day moving average, a hugely bearish technical sign. For those who aren't familiar, Supermicro's whole business is building application-optimized high-performance servers. Their building block solutions mean they can quickly assemble servers for specific needs, whether it's for AI, storage, or cloud computing. Their CEO, Charles Liang, has run this company with an engineer's mindset for decades. They are known for being fast, for being energy efficient with their liquid cooling solutions, and for having deep ties with Nvidia and other chip makers. During the 2024 AI build-out, this was the perfect model. A company like CoreWeave or any number of AI startups couldn't wait 9 months for a Dell order. They needed servers now. They called SMCI and paid a massive premium. That was the expectation phase. We are now deep in the reality phase, where those premiums have evaporated and SMCI is left holding the bag. In fact, their inventory has ballooned to $5.7 billion, up sharply from $4.7 billion. This is a red flag. It means their products aren't selling, and they may be forced to lower prices even further to clear them out, which would crush margins even more. The trading volume on this 3.88% drop is high, but it's not panic selling volume. It's a get-me-out grind. This is institutional selling. You can see in recent 13F filings that while some funds are holding, others like Kovitz Investment Group have been cutting their positions. Insiders have also been selling. Filings show that in the last 3 months, insiders have sold over $3.8 million worth of stock, including the CFO and other senior VPs. This is what professional traders on interactive brokers trading platforms are watching. They see the institutional and insider selling, they see the margin collapse, and they are likely taking short positions. The retail trader, perhaps using the Fidelity mobile app or the Robinhood app for their self-investing, is the one left wondering what happened. The investment help they got from headlines a year ago is now worthless. This is a lesson many learn the hard way about cyclical tech. This isn't a safe investment like a broad market Fidelity ETFs basket. This is a high-risk single stock play in a brutal industry. So what is the path forward? Is there any bull case left for SMCI at this $36 level? The bull case, if you can call it that, rests on 2 things. First, that the AI market sees a second wave. This isn't the training wave, which Nvidia dominates and SMCI benefited from, but the inference wave, where AI models are actually used. This market is projected to be huge, growing at over 22% a year, and SMCI is trying to build servers for it. Management is still guiding for $36 billion in revenue for fiscal year 2026, a massive jump, but the market simply does not believe them. When your revenue just declined 15%, promising a massive ramp-up sounds like a desperate sales pitch, not a realistic forecast. Now, the reality. The risks are overwhelming. The primary risk is competition and commoditization, which we've already seen. Dell, HP, and the Taiwanese ODMs, original design manufacturers, are now fully spun up and are attacking SMCI's market share with aggressive pricing. As a ZAC report noted, Dell's server and networking revenue is booming, and they are taking enterprise customers. These are giants, and SMCI is a mid-sized player. It's a brutal fight. The second risk is demand. Is the AI build-out slowing? It looks like it. The hyperscalers, Google, Amazon, Meta, are becoming more efficient, designing their own chips and optimizing their spending. The growth at all costs phase is over. This normalization hurts SMCI the most, as they were the surge capacity provider. Now the surge is over. Analysts are fleeing. Goldman Sachs has a sell rating with a $34 target. Barclays and Mizuho are neutral. The consensus has flipped from a strong buy to a hold. I want everyone watching to comment below. Do you think SMCI is a value trap or a deep value buy at this $36 level? Let me know. Ultimately, the story of supermicrocomputer is the perfect cautionary tale. The expectation, fueled by the AI boom, is that SMCI was a rocket ship, a picks and shovels play that couldn't lose, a better Tesla stock for 2024. People using their individual brokerage accounts at Fidelity or SoFi Invest piled in, hoping for an easy win. The reality is that they were a cyclical hardware company enjoying a temporary massive spike in demand and pricing power. Now that the cycle has turned, the margins have compressed to record lows, and the competition has arrived, the stock is in freefall. Today's 3.88% drop to $36.44 isn't a new event. It's the painful, logical conclusion of a broken thesis. The market has moved on, and it is signaling that Supermicro's days as a high-growth AI darling are over. This is a company now in a street fight for survival, not a high-growth venture, and the stock price reflects that cold, hard reality. Disclaimer: this content is for informational purposes only. It's not financial advice, so don't make any decisions without doing your own research or consulting a professional. If you found this helpful, don't forget to like, comment, and share. Stay smart.